Income tax deductions. It is useful to plan income tax at the beginning of the financial year in April. Thus, the amount of income tax to be paid monthly can be calculated and monthly installments can be paid accordingly. This payment will make you feel easy and simple while paying income tax in February. In this video we will learn about tax deductions for old income tax system and new income tax system, as tax deductions are important in income tax planning. Knowing this will help in calculating both methods of income tax planning and choosing the method that is best for you. A permanent deduction of 50,000 rupees is allowed on tax credits under the old income tax system. A permanent deduction of 50,000 rupees is also allowed under the new income tax regime. The tax deductions for the old income tax system included house rent exemption. Section 51(2), a family pension income deduction up to 15,000 rupees is allowed in the new income tax regime. ATC concessions are allowed up to 1.5 lakh in tax deductions under the old income tax system. These include Public Provident Fund, PPF, Employee Provident Fund, EPF, Voluntary Provident Fund, VPF. 3-year tax saving equity mutual fund investment, ELSS, 5-year fixed deposit, FD, Selvamagal, Selvamagan. National savings bond and tuition fees can be included in the total amount not exceeding 1.5 lakhs. ATC-CD, 2, of the tax credits for the new income tax system can take company contribution to the national pension system as a tax credit. In tax credits for the old income tax system 50,000 and national pension system, NPS, employee contribution can be taken as tax deduction as per ATC-CD, 1B. Tax concessions for the new income tax system include benefits such as office travel, transport, transfer, daily allowance. ATD medical insurance benefit up to 25,000 rupees per taxpayer in tax deductions under old income tax system, 25,000 for parents under 60 years and up to 50,000 for parents above 60 years. Among the tax concessions under the new income tax regime is the transport concession for the differently abled. Under Section 24B, home loan interest is allowed up to 2 lakh rupees under the old income tax system. Discretionary retirement money is allowed for tax relief under Section 10(10)(c) of the new income tax regime. Medical expenses are allowed as tax deductions under Section 80DDB of the old income tax system. Gratuity is admissible for income tax relief as per Section 10(10) of the tax reliefs under the new income tax regime. Interest deduction on education loan is allowed under Section 80E of the tax deductions under the old income tax system. 10(10)(a) of tax concessions under the new income tax system allows tax concessions for leave concessions. In tax credits for the old income tax system, 80 additional interest on EEA home loan is allowed for tax deduction up to 1.5 lakhs. As per 80 EEB, interest on electric vehicle loan is allowed for tax deduction up to 1.5 lakhs. Charitable donations are allowed for tax deduction as per ATG. Food allowance is allowed to avail tax deduction up to 25,000 rupees. The amount paid as professional tax can also be deducted under the tax credit section. Tax deductions can also be availed like leave travel allowance, LTA, and other office perks. In the new income tax regime, interest concession is allowed on home loan taken on rent. You can use this information to decide whether paying tax under the old income tax system or paying tax under the new income tax system would be better for you. I hope you find this information useful. Thanks for watching this video. Join with us for more useful videos like this.